Welcome back, everybody. It is Tuesday night, and so of course that means VA Live. So we thank you for joining us. We have another crew of experts from around the country that are part of the vetted VA community, and we're maybe a little bit ahead of the curve with tonight's topic. We're going to be talking about VA cash out refinances. So since October, I think October 19th, we had a peak on the 10-year Treasury at a little over 5%. Mortgage rates, not VA rates, but conventional mortgage rates peaked at over 8% that same week. And we've seen about 1.5% correction and improvement in interest rates since that time. If you saw any of the Fed announcement last week, they're projecting many rate cuts next year. That doesn't directly impact rates on the mortgage side, but likely to lead to lower rates. So although we're coming off of a year of very low refinances, like 10% of the refinances that we had at the peak level, about 92% of the refinances that are being done this year are cash out. The VA loan program is far and away the best and most lenient of all loans, but especially on the cash out refinance side. So whether you're thinking about it later in the year, whether you've been thinking about it today, we're going to go through all of the details tonight that you need to know to be prepared if and when a cash out refinance from the VA side makes sense for you. So with that, David, you want to just give us a super basic overview of what a cash out refinance is?
So for what would we consider a cash out for VA is a little bit different, but we'll do a basic, right? But because there's a cash out 1 and cash out 2. So, but if you're looking to do debt consolidation, pull a little cash out, maybe you have a divorce, right? That you have to buy out a partner. Or let's say you have kids and you have to pay for their college. Those would be all reasons to access your equity, pull some money out, and that would be the basics, right? So with a VA, shall we go into that or no?
Hold that thought, and I'm going to come back to you. It's an important point, but let's compare it, because what's the most common thing? The thing that everyone is always talking about when they use their VA benefit and they buy a home, they're always told, hey, you can always do an IRRRL. So Chris, maybe walk us through what's the difference here, cash out and an IRRRL. There's some very significant benefits in terms of the simplicity of an IRRRL, but there's also limitations. So very different from a cash out refinance. So maybe walk the viewers through the difference between the IRRRL that they've heard so much about and an actual cash out refinance.
Okay, so the VA IRRRL is interest rate reduction refinance loan, and that would only be if you are currently in a VA loan. So that's an added benefit if you're purchasing now, if you're deciding between conventional VA. VA is a great option because you get the simple VA IRRRL refinance loan potential down the road. The reason why it's such a good loan is because it's a no cash out refi. You're just reducing the interest rate. There's no appraisal, no income documentation, or the cash to close can be built in. And the VA protects you by having a 36-month recuperation period to make sure that you're not getting charged excessive amount of points and chewing up your equity. And then a VA cash out loan would be offering up to 100% of your home's value to take out in cash, minus the difference of what you own the home.
So really, someone looking at an IRRRL is just saying, I have a VA loan, rates have dropped, I'd like to take advantage of the lower rate, don't need any money back, versus someone cash out, maybe rates dropped and they get that benefit on top of it. But for the most part, they're saying, I would like to access some of the built up equity in my home that I've established over these years. And that's where we would look at this option versus the streamlined and simplified process of the IRRRL. Is that about right?
Correct.
So David, why don't you walk us through the difference there between the two cash out options with VA?
And I was about to pull those up because I always get them confused. So hold on one sec. Let's see.
Well, let's yeah, you want to go through it, Ariel?
Yeah, there we go.
So type 1 cash out is when you're going from a non-VA loan to a VA loan. So if you're going from a conventional to a VA, most of the time when I've seen these, they're normally on private financing kind of deals where someone's bought a home with private financing or builder financing or some kind of construction loan, and they're refinancing to a VA after the fact. So that's a type 1. They are limited on the loan to value. Standard cash out protocol applies. It still has to meet seasoning requirements, still has to meet the net tangible benefit, the veteran requirements. There's a form that gets filled out. Most of the time it's going to nix the mortgage insurance, and it's going to be cheaper on a monthly basis to use a VA loan than it is to get a conventional, even if you have perfect credit. That's type 1. Type 2 is VA to VA cash out. So you already have a VA loan and you need to take cash out of your home anyways, which is also perfectly fine. That is, again, VA to VA. Loan to value limit, the maximum amount you're allowed to take out is going to be 100% minus the funding fee. You can't go to 103.6. You have to keep it at 100% total. So whatever your funding fee and closing costs are that you're planning on financing in, you're going to take that out of the cash that you would need to get out of your home if you're going up. Oh, it's hard to hear me. How's that? Is that better?
We can hear you pretty good from this side. It may be on the TikTok side where you're having an issue.
Oh no. Technology and me are not friends.
Did you just cut the power to the house?
Listen, I'm real good at VA loans. That's about it. So anyways, type 1 cash outs are, or type 2 cash outs are when you're going VA to VA. Hold on. Hold please. I don't know what I did.
We had to go all the way around the back to it.
On to the next question.
Let's just talk. So she was hinting at talking the specifics of the differences between those. Why don't we talk a little bit about the loan to value that you are able to go to on a VA loan and how that varies with other options like a conventional loan or an FHA that people may have heard of, because it's one of the big benefits. So David, do we have any limits besides what Ariel was talking about, not being able to add the financing fee on top of it, but do we have any limits when it comes to how much of your home's value you can borrow?
Well, you can get, you're saying for which one? Just period for VA cash out?
Just for your regular VA cash out, VA to VA cash out.
I mean, you're max out at 100%, but lenders are going to make it not as attractive, or what's a better way of saying that?
Disincentives to go to 100%?
Yes, there we go. Disincentivized to go, over 90%, right? And that's something that really went into play, I think, like during 2020, right? Like during COVID is when they really made it, they added on. And then the other thing to keep in mind is for the VA funding fee, right, being a lot higher for a cash out, they don't have any LTV adjustments, right? It's just the standard. So I was trying to type in what the feedback that I'm getting from Brandy, Ariel. So that's why I'm like off.
Oh, you're good.
So let's see. Is that what you were going for, Josh? Did I answer your question correctly?
So in general, it's the only program that's going to let you go to 100%. If we're looking at the conventional loan, if we're looking at an FHA, you're looking at 80%. So it is a benefit that veterans have that, despite the fact, if we look at it, even if other programs did allow you to go to 100%, the terms would be much worse than what VA is, even with the loan level price adjustments. So Chris, in terms of, let's say you had someone that wanted to go to 100%, do all lenders offer 100%, or does it vary by lender? And sort of those loan level price adjustments that Ariel was talking about, are they consistent from one lender to the next?
Yeah, so not all VA lenders may offer this program, so it could be important to you if you really do need the 100% and you're willing to take on the kind of the added pricing challenges or barriers of doing 100% cash out financing, to make sure that you're shopping around to make sure that somebody can offer it.
Ariel, you had talked a little bit about the funding fee, and the funding fee can be a big impediment here. So the great thing is I can go to 100%, but if I've used my VA loan before, that funding fee can get pretty expensive. Do you want to kind of go through that of what it can look like if we go as high as 100% or not, even, and maybe where the people that I see, you guys are right. We talked at the top of the show. These are limited. We don't have a lot of people reaching out to do high loan to value cash out, but oftentimes when they do, it's people with a permanent total disability that are exempt from it because it's even more attractive to them. But you kind of, Ariel, want to walk us through what the funding fee can look like and how that can somewhat be an impediment to go in this route?
Yep, and it's one of the only times I've ever had a veteran where I told him conventional would be a better deal to do in a refinance. It's probably one of the only times I've been like, okay, it's cheaper for you to do conventional than it would be to do VA because of the funding fee and the loan amount. So even if it's going from conventional, a type 1 VA cash out to a VA, it's still going to be considered subsequent use for the funding fee, which is 3.6%. that can be a lot of money depending on what the loan amount is and depending on how much equity you have in the home. So if you have 50% or more equity, that funding fee may be a bad idea at that point, not even pushing it to the 100% mark, but that funding fee does get wrapped into the loan and it takes away part of the equity. So again, it depends on the loan amount. There's a lot of factors that go into it. And I tell most people, let's do a cost analysis before we decide that VA is 100% the best route, because again, it's one of the very few times where the rates may be cheaper. It depends on credit score, what the amount of equity you have is. The funding fee most of the time will supersede the need to go to a different loan program, just because, yes, it's 3.6% for a VA cash out refinance, but how much is it going to save you on the rate? Since VA has the most lenient, when you start to creep up to the higher LTVs, that's when you have to be a little more careful and go, okay, is it a savings to the veteran to do this? How much are we saving them on a monthly basis? We go to net tangible benefits really with that, but.
And this, again, it's one of those areas where all veterans, once their loan is recorded and the call center shops and the mail houses that can look and see that you have a VA loan, no one really is telling you about this. They'll just send you the flyer. You'll see something in your mailbox that says, hey, great news, you can go to 100%. But they're not going to do that breakdown that Ariel just did for you. There are times, if you've been in your home for an extended period of time and have built up equity, that you need to look at that side-by-side comparison. VA have a lower rate, but you have that funding fee. And it's really important that you're working with someone that can walk you through it, because we always talk about here on the show, it is very rare that the conventional loan is the better option, but that is probably one of the top 2 or 3 areas where it ever would come into play and be more beneficial. Chris, if you have someone coming to you and saying, hey, want to do a cash out, what does that process look like relative to, say, they've never refinanced at all before? Is it the same whole rigmarole of all of the documentation? Are we looking at the same everything? Where do you start with the borrower, and what should they be looking at needing to provide you to get them pre-approved for a cash out refinance?
Okay, so first I'm looking to see what their eligibility is to make sure that they're veterans that's eligible for the program. So I'm looking at their certificate of eligibility. I can pull that, or they can provide it to me. Make sure that there's enough eligibility remaining and entitlement to take the cash out of the loan. Then I'm looking just really quickly, what's their equity position? Is the house worth 400 and they owe 300? And then I'm looking at a 90% or 100% option, talking about their goals. But as far as documentation, I'm looking at ID and income. So I'm looking at their driver's license, their DD-214, their pay stubs and W-2s, or maybe their VA disability award letter, pension award letters, and Social Security award letters are kind of like the typical things I'm collecting to qualify.
So really, other than refinance versus purchase, the big difference there that I'm hearing is you're going to get the info on the current mortgage. You can get that mortgage statement and their current homeowner's insurance. How about assets? Do they need to provide assets and show where their funds to close are coming from? Most times in cash out, we're getting money back. Is it an area where you get a little more lenience?
Right. So there's not usually going to be assets collected unless maybe there's a low credit score situation or a manual underwriting situation where reserves may be required to strengthen the file. But for the most part, because you are getting cash back, the closing costs are being built into the loan amount. So not to say that it's free by any means, there are always closing costs, but they are baked in a sort.
That is a really important part of the discussion. So let's definitely hold that thought and circle back to it. David, you and Ariel were talking earlier, LLPAs, differences in going to higher loan amounts. How about when we look at things like credit scores on this? Is there a difference? Does VA set a limit? Do lenders set limits? What does it look like depending on where your credit score may fall on that spectrum?
Right. Yeah. So VA, as well, most of us should know with some of these lives, is that they don't have a minimum credit score. That's going to be what the lenders are going to imply. So if that is something that you are concerned about, I would be upfront with the loan officer to let them know, hey, I don't think my credit's the best. Or if you have a good idea, this is a little plug, but if you, good Lord, the good go bag, there we go. You can monitor and actually see your credit score, your mortgage credit score, actually, which is the more important thing when it comes to refinancing, to actually be able to have a good idea of where you're at. So again, and that's something that is provided just for being a member. It's You're not going to be solicited from our partner on that. So if you're not taking advantage of that go bag, make sure that you put a link in so we can make sure we get you that website information so you could sign up for that. But
what
as
comes
far
in
as
the go bag?
Say that again.
What comes in the go bag? I tell people to go sign up for that all the time. I have no idea what comes in it.
Well, the biggest thing is that credit and monitoring, and they could even do like a little simulation aspect of it, kind of like Credit Karma. If a lot of people seem to have that. So, but it actually gives you your mortgage score versus your consumer credit score. So not to confuse people, but there are like 50 plus different credit score monitoring. We only care about the mortgage side when it comes to the VA home loan, right? So, but as far as credit scores being required, that's going to be based upon the lender. So if you want to get upfront with that, there's a lot of lenders that do have, and I'm not going to name names because I think I'll get in trouble. So I'm just going to say there are lenders that have like a 620 minimum. There are a ton of different lenders that will go below a 620. So don't let that be if you're getting that type of information from a lender, don't let that be your automatic, oh no, I can't even do a VA cash out or a VA purchase. That's why you want to make sure that you're talking with a vetted pro, right? If I'm being a little biased, but or just get our opinion at least, and we'll let you know. No, look, we actually do have X, Y, and Z lender that's going to be able to take care of you. So the other thing I was going to mention before I forget, because I'm clearly scatterbrained tonight, is we need to make sure we address the issues on property, right? When you're doing a cash out, because you are kind of starting over with that, meaning you're going to actually have a VA appraisal, which means that we have minimum property standards. And if you're in the lovely state of California, like I am, then that means that you're going to have to potentially be aware of getting like a termite clearance, but I don't want to dive too much into that.
I want to go back to what you just said. Sorry, I didn't mean to like raise my hand like a 5-year-old, but I did want to go back to what you just said about mortgage credit reports, because unless I'm mistaken, we are all mortgage brokers on this right now, right?
Yep.
Yeah, for sure.
Okay, so I've had some veterans who've reached out about wanting to do IRRRLs or cash out refinances since rates have come down, which is obviously understandable. One thing that I think a lot of veterans should be aware of is the difference between the mortgage credit report and what a hard pull credit report is, because the IRRRL technically doesn't require a hard pull credit report. It's not an underwritten loan. We don't run underwriting findings on those, whereas on a cash out refinance, we do. And there is a very big distinction between those two things, which I'm sure we're going to cover later on in this. But the importance of shopping lenders, especially if you have concerns, because the IRRRL program allows for you to also catch up your late mortgage payments, which is another huge benefit of the IRRRL program. And some lenders will not allow you to do that. So just retweeting what he said, shopping lenders is really important, especially if you are looking for a good deal on an IRRRL and you're concerned about credit.
Well, just to that point, in prep for this, I jumped in Loan Sifter. So for those of you who what world is Loan Sifter, the tool that we can use, we can put all the parameters of your loan, and it has all the investors that we work with, and it spits out who will do that loan. Well, cash out to 100% eliminates many of them. Many of them just have that overlay. We're not going to go over 90. Well, then if you're at 95 or 100, you say, well, I got a 600 credit score. Well, now we eliminate even more. So that shopping in this instance, if you fall into those in any of those categories, you're going to 100%. You want to just do the credit score if you're doing an IRRRL, just the mortgage credit report. So all of those things come into play here, in that if you call a lender, this is not to make a differentiation between a broker and a lender. Either one can get you very good terms, but if you go to a direct lender, they probably have 1, 2, 3 investors, and they are going to be subject to what they offer. You go to a broker, we all have 20, 30, 40 different places that we can go to. And depending on how narrow the constraints are of your situation, it can narrow down. And even within that, when you start looking at VA doesn't change pricing for lower credit scores, but all of these lenders set their own loan level price adjustment. So I was just looking at it. It was interesting seeing one had a 1.25 hit and the other had no hit. But because the one with the 1.25 hit had so much better pricing to start with, they were still better. So it's like looking at that is really what your mortgage professional's job is figuring out the criteria of what you want, what you need, and all of the attributes of your loan, and then matching it up to all of the best options out there. We did a good job here already of comparing kind of VA versus conventional, which that is often a consideration. We talked about FHA limits you to 80%. Really, I can't think of almost any situation where someone who's VA eligible would go FHA. You have many of the same constraints, but you could go higher. But over the last few years, why don't we talk a little bit about, with interest rates higher, a lot of people with 2.5%, 3%, 3.5% VA mortgages, they want that cash out, but they certainly don't necessarily want to give up that rate. Chris, if someone comes to you and they're needing cash out, how do you advise them? And we can kind of go around the horn on this because it's everyone's going to deal with it differently. But in what situation does a home equity line of credit or a fixed second mortgage make more sense than a new first mortgage with cash out?
When I'm talking to somebody, I'm just thinking about if they were my own parent, friend, family, or anybody like that. I want to give them the best advice, even if it means that they're not working with me. So what I start out with are, what kind of like just the main goals. What's your main goal? So that would be, how much cash do you need? What are you using it for? And then when we're having deeper conversations, looking at if they're paying certain items off, kind of just weighing the pros and cons besides a VA cash out and giving that interest rate up in a home equity line, and how it's going to benefit them in terms of cash flow or saving on, high interest rate debt. So starting at that point is where I'm usually at, like in terms of discussing HELOC. I have no problem with either option. They're tools, right? The more tools that you have at your disposal, the better.
Absolutely. And as rates improve, hopefully they continue moderating. We may lean more back towards doing cash out refinance, kind of why we're going through this tonight. Ariel, this is probably a situation where you're talking about the funding fee. If someone wants it's a $300,000 property, they want $100,000 cash out, and they're looking at a 3.6% funding fee on that, could push someone towards a home equity line of credit or a fixed second. That, and I always like to look in terms of the blended rate. What's the rate on that second? What is the rate on the first? We also have to take into account that line of credit, most of those are variable rates, which over the last 2 years has been terrible. If and when rates start coming down, it'll actually move to your benefit. Ariel, do you have any additional thoughts of how you went through those numbers and talk to borrowers when they're looking at options for taking cash out?
Yep. Hold on one second. Please be quiet. I'm on a meeting. Okay. Thank you. I love you. Sorry, parenting, multitasking. What I normally will do when somebody contacts me for VA cash out is go through the standard VA cash out options and then look and see if a HELOC would be better. Is it going to be a better cost analysis over a long period of time? Does a HELOC benefit them more based on what their plans are for as long as they're going to live in the home? And go through both numbers. Most of the time we wind up doing the VA cash out refinance anyways, because home equity lines are great. It depends on what you're using it for. If you're using it to pay off debts and consolidate, typically I'm going to recommend a home equity line first, because home equity lines will still save the same amount of money as a VA cash out would. But the payment winds up being smaller because you're financing a smaller amount of money. And yes, it's interest only, but if you apply X amount of money and set a budget towards your principal, you will continue to knock it down, and it winds up being an easier thing for them to utilize and to help manage money. If they're doing big renovation projects, it depends. We go through the whole cost analysis of this is a revolving amount of interest on your home for X period of time, unless you can dedicate the resources and time to paying that down. Great for debt consolidation, not so great for home improvement to do home equity lines, in my personal opinion. And I explain to them why, and I tell them these are both of your options. Here is all of the numbers you need to know. This is what it's going to cost you to do a refinance long term. This is what's going to cost you to do a HELOC long term. Like, I do individual consults as much as I can for every single person.
It really requires it. You have to do that side-by-side comparison. Almost everyone has options. I mean, if we have a veteran coming to us and they're doing zero down purchase, we're not going to compare other loan programs, but you're going to compare a couple of different structures. I mean, that's a good transition to what we're talking about. Chris had talked about cash out refi. All refis are going to have costs, and there's many different ways of covering those costs, especially with the cash out. We can just use some of the cash out to cover it. We can get a lender credit to cover it. David, how do you go through that with borrowers? And when you're comparing and presenting, what are the things?
Really comes down to, like, what is their short-term and long-term goals for the refinance in itself, right? Because we actually have the ability as a lender, well, and it's up to you guys as the client to increase your interest rate to actually cover the costs, right? So the big thing that we want to make sure that if you're talking with a lender is that they're giving you the break-even analysis, or break-even point is what I usually typically call it for the refinance. So then there's also going to be like, good Lord, it came and went.
It happens. It happens all the time.
I swear, once I turned 40, it's like,
hey, listen, I just turned 50. I don't want to hear anything about turning 40.
yeah,
I was sharp as a tack still at 40.
Lord, what was I going to say? But so I was talking about bumping up the interest rate, but even what I was going to say is on the vice versa, right? If you want to get your payment to be a little bit lower, that's going to be key of really understanding how much the points are, right? Does it really make sense? So that, again, you want to have at least a couple different options, right? And I know I'm a visual person, so like I love, well, now I use Barry Abib's presentation where it allows me to do as many different scenarios as I want to do, but I used to use Mortgage Coach where it allowed me to do 4 different scenarios of breaking that down so they can actually see exactly how much it's going to cost them, and then be able to have a really true good explanation of what it looks like, not just right now, right? Because a lot of people are only concerned about their payment and cash to close, but I want them to actually be looking at it like, how does this align for their 1 year, 5 year, 10 years, 15 years down the line? So some people don't care about that, but I want them to actually have access to that information, to see that, to make the best educated decision for them. So, because I'm going to have my ideas. Sometimes they're right, sometimes they're wrong, So I want to give as much information as possible, so then they're able to come back to me and be like, you know what? I actually looked at doing the cash out of 95%, and with me paying off a car or whatnot, even though that we're just using a hypothetical, right? This allowed me to be able to put that same amount that I was saving on that monthly payment to pay off my house in 5-10 years, whatever that might be, depending upon the payment. So,
and within the context of any cash out refinance, VA or otherwise, there's always a risk of it looking like monopoly money. When you're going in to buy a house, you know how hard you worked to save every nickel that's sitting in your bank account, and you're much more likely to look and see exactly where it's going. What I see is when it comes to cash out, it's kind of a rounding error. Well, if we pay a point, I get the rate a little lower. I don't really know what that additional $2,000, $5,000, $10,000 was to get it. I just like the lower payment. So it's really important that your loan originator is going through and showing you what that looks like, as you said, in 1 year, 3 years, 5 years.
And that's the thing, like, gosh, I want to say names, but I know I'm going to get in trouble if I do. So I'm not going to. I'm going to take a deep breath. That's what a lot of these competitors are doing. They're trying to get, I'm going to call it a teaser rate, right? So they're doing it on the mailers, and that's, look on the back side of these mailers, and you're going to see that they are charging like 2-3 points, or sometimes they'll even call it an origination, which you can't really do more than 1% on a VA. That's here nor there. So you want to make sure that they're actually giving you that detail, and they're not going to. What they're trying to do is get their phone to ring. So keep that in mind of, like, they're going to be, oh yeah, I'm going to have to say, like, I'm going to just make up a rate. Like, oh, we're giving you a 4.75% rate, right? And the APR is like 5.9 something. That's a huge red flag right there. Just that I'm super oversimplifying it, guys. So don't beat me up in the comments. But like, if you're seeing a big difference on VA, right? Especially if you don't have a VA funding fee between the interest rate and the APR, that's a huge red flag in itself. So, yeah.
Can I segue? Can I add to that? I know it's off topic, but I so want to add to that.
Absolutely.
Yes, of course.
Okay, so this is the Equal Housing Opportunity logo, guys. To David's point, when you get these mailers in the mail, it's going to have this logo on it. That means that it is not your mortgage company, and you don't have to answer it. You can toss that shit direct. Sorry. You can toss it directly in the trash. and ignore it. It's a solicitation. You need to read the details on it very carefully. Sorry. You need to read the details of that notice and disclosure very carefully. They are often marked to say, this is, you have to respond to this, or we need your input on this, or these other like pushes to get you to do something that you are not supposed to do or don't have to do in order to refinance. And you need to pay attention again to what he said. The rate and the APR are two separate things. What interest rate they're offering you dictates what the cost is, and that's part of your APR. You need to be very careful when you're looking over those flyers that you get in the mail. What the other thing that you should be looking for is whether or not there is an NMLS number of any kind, company or specific loan officer on that disclosure, because when they are soliciting you, they are required to put the NMLS number on those disclosures. That is important.
Well, everything that both of you said is important.
I get the
in
text all the time where
this,
people are like, hey.
Well, VA and FHA loans are the ones that are subject to the mailbox being stuffed full of mailers. Everyone is getting bombarded with advertising and marketing everywhere. So, David, you don't have to say who you're thinking of or thinking in terms of. In terms of VA loan origination, the biggest VA lender in the country is basically an online marketing organization. So when you look at it, Christopher Griffith, who started Vetted VA, part of the genesis of this was wanting to make sure veterans are getting a good and fair deal. It's not to say the absolute most rock bottom interest rate and someone's going to do the loan for free. Everyone here that is vetted is committed to getting veterans excellent deals. And when you compare it, it compares very favorably. So if you're looking at whether you're a company that markets aggressively online with a lot of pay-per-click and feeds your call center, or you run Super Bowl ads and you feed your call center, or you send out tons of mailers and you feed your call center, you are spending a lot of money on marketing to funnel borrowers to a kid in a call center who's done loans for about 5 minutes, is trained on one product, and is trained on the pitch. What Ariel was talking about, what Chris is talking about, what David is talking about, how do we advise someone? How do we lay out all of your options? I don't know what's right for you, but I know what all your options are, and we can kind of pencil those out in a way that you can follow along and understand and decide which is best for you. So that's not to say never follow a pay-per-click ad to see what they're offering, never call the Super Bowl ad to see what they're offering, or never call on the thing that shows up in your mailbox to see what they're offering. But make sure you talk to an independent mortgage expert and just see and understand what that difference is. If you talk to me and you talk to a kid in a call center and you don't obviously and intuitively see the difference and the value and the benefit to you in working with me, well, then I failed and there isn't a benefit there. Feel free to go that route. But what we see is people think, well, this is the biggest VA lender in the country, so they have to be good. Or these guys told me in the mailer that showed up that they have the lowest rate and it looks way lower than what I've heard anywhere else. So chasing that without verifying and talking to another lender is a recipe for getting yourself in trouble. Chris, it looked like you had something to say there while I was running on about making sure of who you shop with. Did you have something you wanted to add?
Well, the word shop, right? So we're talking about comparing and contrasting. So definitely shop around and advocate for yourself, because at the end of the day, that's what it's all about, is looking out for yourself in the best terms. So comparing interest rates, comparing origination fees, and also when we're talking about points and fees, know the interest rate environment, or try and gather that or get people's opinions, because in a declining interest rate environment, it probably wouldn't be smart to pay a lot of points right now on your purchase or on your cash out refi, because there might be that potential of a refinance down the road where maybe then spend the points, or it could always be safe just to take a really low cost option. So know your different options and compare and contrast and look out for yourself.
Absolutely. Know the options, look at the break-even periods, and know what your short and intermediate and long-term objectives are. So I think we've done a pretty good job of covering most everything here on the VA cash out. So I kind of want to do two things, and we'll do it all at once. We'll kind of go around the horn. And what I would love to do is hear you guys' thoughts on what's changed over the last couple months with rates coming down. We're heading into the new year. Lots of people, their New Year's resolution is going to be they want to buy a home and they're going to get out there. So what is the advice to people wanting to take advantage of rates coming down to either buy or refinance and get ready to buy in the new year? And then also, if there's anything that you feel like we didn't cover, you wanted to add to the discussion on the cash out refinances, feel free to add that. So we're going to leave Ariel with the last word. So David, why don't you start us off?
Okay. All right. So I would say rates coming down the 1.5%, I would say, right, over the past couple of months is huge as far as helping out purchasing power, or if you need to refinance, right, it's going to make a huge difference. Just shop around. That's the best thing. Even if you're talking with a lender that you've talked with in the past, because this is how I approach it. If I have a past client that comes to me, I even tell them, hey, if you're not liking what I see, shop around. All I ask for is the respect to just be able to get an opportunity to compete. But another thing that Chris was saying, like, keep in mind, try to maybe have a good idea of what is going on, because rates could change a lot. We're not really expecting them to change much over the holiday season. But with that being said, with people taking time off, the mortgage-backed securities, they trade like the stock market. So when there's less trading going on, there could be volatile swings just because there's illiquidity in the market. So, but that being said, we're not thinking there's going to be a huge upswing in interest rates over the next couple of weeks, but make sure that you are trying to compare apples to apples. And what do I mean by that? Make sure you're comparing them on the same day. So the only other thing I want to say, like as far as the cash out, because I kind of dove into it a little bit, is making sure that if your property has anything that you think might be called out, to be upfront with your loan officer on that. So, because that could be an issue that you want to be aware of upfront before paying for an appraisal. So, because you are going to have to meet the minimum property requirements on a cash out. So, other than that, hope everybody has happy holidays. And I will give it over to Chris.
Yeah, and I'm with you, David, and a couple things, because you mentioned the word pest earlier, so I'll get to that. But yeah, the VA cash out refinance, the appraisal, try to do your best to have a clean home and like everything situated so you don't get flagged on any small items. But if there's a railing missing or a little bit of chipping, peeling paint, it can always be fixed, and there might just be an additional trip for the appraiser to check that off the list. Also, what I think is unique to VA is that in certain areas there could be if you're on well water, you might need to get some water testing and possibly a pest inspection too in certain areas of the country. Myself in Michigan, half the state needs a pest, half doesn't. So it's another thing to be mindful of, and another expense when comparing VA cash out to home equity line, comparing costs. Other than that, I think we covered a lot and we're super productive. So I'll defer.
I was going to say, Chris, I thought that the pest inspection map is like a U, and I thought you guys were right in the middle of the U where you didn't get impacted. Only half the state avoids having to have pest inspections in Michigan.
So if you're a Youper, you're totally good. If you are kind of near Traverse City, you're good. But yeah, you have to reference the map on that one. Or what I do is I just have a note. I always remind myself about the pest inspection in Michigan. I have all the counties that require it and don't require it. So
Ariel just looked at you like she has no idea what a Youper is. Apparently in North Carolina, they're not familiar with the term.
Well, that would be the Upper Peninsula of Michigan, the UP.
Isn't that a card game?
No, but if it is, I love card games, especially Michigan's very own Euchre. Great game.
All right, Ariel, you get the last word tonight.
That's what I'm thinking of. Okay.
You got to listen to David and Chris for several minutes.
Words of wisdom or both?
All of the above.
All right. So whenever anybody contacts me about a refi, these are the things that I warn every single person about. Like I legitimately will spend 45 minutes to an hour, regardless of whether or not they actually do a refinance, giving them this is the protocol. So my cliff notes of that is, if it's a VA IRRRL, here is where your break-even point is. Here is what the VA requires the interest rate to be at. Do not let anybody tell you different. Here's the handbook. The VA requires your interest rate to be naturally 0.5% below where market is. They require 210 days and 6 payments. Point blank, plain and simple, that is what the rules are. No lender is going to be able to get around the VA's rules. So please do not fall for any solicitation scams. These are where your options are going to be. This is where the rates have to be in order for you to be eligible for this. Do not let anybody try and get you out of this, because normally they have a pretty good interest rate, or if we're trying to get them into a lower interest rate, we've set a timer. We're just waiting for the market to do what it needs to do for IRRRLs. Like I set up a rate alert. You will be alerted as soon as rates are where they need to be in order for you to save X amount of dollars. I do all the upfront numbers up front. Is it a cost benefit? What's the dealio? Let's get all this work done up front and have a whole analysis up front. That way, if you're going to shop, you know what you need to shop for. If it's a cash out, I go through a cost benefit analysis again, and I say, is it going to be worth it? How much money are you going to save per month? I'm getting debt right now because people's finances have changed with inflation. They've changed with a lot of the cost of living going up. So we are consolidating debt and making affordable living a thing again when we are doing cash outs for the most part, from what I have seen. Or we're changing over to a more affordable type of financing, VA financing. How much money are we going to save you? Are we rolling closing costs in? And this is what the cost of closing is going to be financed into your loan. Are you okay with that? Yes, we have informed consent. I love that for all parties. Let's do this. Or this is what we need to do to get you ready to refinance, because VA doesn't require the rate to be lower, but they do still require a net tangible benefit. That is still a mandated piece of paper that needs to be filled out. So we have to make sure it is a benefit to the veteran. And I go through all that before, realistically, if I can get it done before we pull credit, and then we fine tune it once we have the credit pull. Don't let anybody pressure you into doing something. You can have a cost analysis and go through all this without completing the actual refinance with a dedicated lender. Don't let anybody push you around. Get copies of the numbers that they're giving you and then review them. This is another big decision. You are still changing what you're paying per month. So make sure that you're comfortable with whatever the payment is, especially if the payment's going up with the cash out refinance. That's it.
I like it. I like it. I'll leave you guys with this. I always like to point out a few things. 65% of American households in any given period of time choose to be homeowners. They have 40 times greater net worth, and 50% of that net worth is in home equity. So we're talking about utilizing that home equity tonight. It's an important thing. We need to remember that our objective for most people, they don't own multiple properties. They own one property and it is their home. We would like to, over time, be progressing towards paying it off. So we talked about a number of examples tonight where it makes sense to utilize that equity as a tool to pay off other more expensive debt, to pay for kids' school. Any number of things can make sense in doing this. But let's always keep in mind the big picture, that we're trying to progress to a point where we have mortgage freedom, where we own a home with no mortgage payment, and it's making our life better as we progress towards retirement. So great tool. Awesome use of your home equity, but with that power is responsibility. It's responsibility to be thoughtful, work with a professional that can guide you through this, help you analyze the numbers, answer your questions, and make sure you're making the right decision. So appreciate you guys for being here with us, walking through everything, answering everybody's questions. We will be back next week with another group of vetted pros, and I believe that's actually the day after Christmas. So we'll come back, everyone will have their Christmas presents, they'll have new cameras and new computers and new microphones and all that stuff, and it will be amazing. So you guys have a wonderful Christmas, and we will see you back here on another episode in the new year.
Thanks, Josh.